When you've got someone in a debt crisis and the whole thing's failing and it's likely to trigger complete financial chaos, why have anything in it? Just get the hell out. And the only way you get the hell out is to get out of credit and get into real money, which of course is gold. That is the message that central banks around the world now understand. They may not admit it, but basically that's why most of the central banks, and okay, not the major ones aren't admitting to anything. They're just keeping very, very quiet. They understand completely what's happening to the credibility of the dollar and all the other Western currencies. And so they're getting out. That's really led to demand for gold.
Gold continues to surge, and rising U.S. debt levels and elevated yields should help keep the precious metal bullish. Gold prices are already up over 30% for the year and could keep climbing. The head of the U.S. bank, who later became known as JPMorgan, actually said that when speaking about credit, it is evidence of banking, but it is not the money itself. Money is gold and nothing else. Alasdair Macleod, renowned as head of research for Goldmoney, states that in a debt crisis, the safest move is shifting from credit to gold. He mentions that while major central banks stay quiet, many Asian central banks recognize the waning credibility of Western currencies. Over the past decade, China has steadily reduced its holdings of US Treasury securities. At its peak in 2014, China held approximately $1.3 trillion in US government debt. By 2024, that figure had dropped to under $800 billion. Instead of reinvesting its dollar surpluses in US debt, China has diversified into other assets, such as gold, oil, and base metals. In his analysis, Alasdair dismisses the prospect of a new Brics currency, suggesting it's unlikely to happen. Instead, he notes a shift might only occur if Western currencies collapse, potentially pushing China and Russia toward a gold standard. Previous predictions about the dollar's demise, including after the 2008 financial crisis, have not come to pass. But some economists say that the dollar's role in the international financial system should not be taken for granted, because there are economic and geopolitical incentives for other countries to de-dollarize. Indeed, several countries, particularly those in Brics, are trying to resist the dollar's dominance. Highlighting the fundamental differences, Alasdair notes that, unlike the European Union, Brics operates mainly as a trade union focused on promoting free trade and mutual investment. This includes infrastructure projects designed to boost the export of key commodities. Now we present the clips of Alasdair Macleod's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The new Brics currency is not going to happen. Forget it. I mean, it really is. So I think we just dismiss all talk about it. If anything happens, it will be as a result of the collapse of our currencies, because our currencies are credit. As someone said before a congressional committee a long time ago, the dollar depends on the faith, if you like, that people have in it, the faith and the credit in the US government. When that collapses, then there may be a change. And I guess that the change will not be a new Brics currency, but what it will be, I think, is for defensive reasons, China and Russia putting their currencies onto a gold standard. Now, whether they do it properly or not, we'll have to see at the time. I mean, it's very, very simple to do. I think that's the important thing. Now, in terms of any comparison between the European Union and Brics, the big difference is that the European Union is a political union, whereas Brics is in effect a trade union. It's a union based on if you like, free trade between the members. That's the whole point of it. And principally, it's not just free trade, but also the recycling of investment to improve the infrastructure in these countries, allow for the extradition of commodities and all the rest of it. I mean, for example, the building of a railway from Mombasa on the East African coast all the way through to the Congo is all about shipping out, sort of things like cobalt and copper and, all these wonderful things that are being discovered in the Congo. In return, of course, the Chinese, are importing capital in, so the currency thing doesn't really matter in a sense. What they're doing is they're importing capital into places like Kenya, Uganda, Belgium, the old Belgian Congo, the Congo, Central African Republic, and so on. The idea basically being that by improving communications, by opening up the country properly, investing in it, then everybody's going to benefit, including China. The only country with a problem in this, I guess, really, is Russia, because Russia is a huge net exporter of energy in particular and other commodities. It does not have imports that match. So she is always having to import other currencies, which is the result, if you like, of her sales of energy in particular. So she's up to her neck in Indian rupees, for example. Now, that's not a very happy situation for Russia. And I think that's why Russia was actually quite keen to push the idea of a gold-backed Brics trade settlement currency back in August last year, ahead of the Johannesburg summit. But that is now a dead duck. That's not going to happen. If, as I say, if anything happens, it will be as a result of the collapse of currencies in the West.
Market analysts, including Alasdair Macleod, assert that gold's purchasing power has remained stable over time while currencies show significant volatility. For instance, oil prices are much lower in dollars today compared to 1950, but higher when measured in gold. Thus, fluctuations in gold prices primarily indicate a weakening of fiat currencies. In fact, since the creation of the Federal Reserve in 1912, the US dollar has lost nearly 98% of its purchasing power. The gold price, on the other hand, has multiplied 100-fold. This may seem like a lot, but gold has just maintained its purchasing power. Today, 1 ounce of gold purchases approximately the same goods and services it did 100 years ago. The erosion of the US dollar's global dominance is not happening in isolation. It is part of a broader global financial system realignment, driven by geopolitical tensions and economic pragmatism. Regarding market dynamics, Alasdair asserts that gold and silver market behavior will persist due to derivatives. He warns that traders risk large losses from short positions as prices rise, prompting bank treasurers to consider unwinding these positions to protect their balance sheets. Let's get back to the interview.
I think the answer is that you'll continue to get that sort of market behavior so long as we have derivative markets, whether it's futures on COMEX or forwards in London, because that gives huge leverage to people who want to play games with real money. And the thing is that these people playing games, they don't actually understand that gold and silver are real money. By law, by everybody's common law, they are up to their necks, if you like, in short positions. They want to retrieve that. They make a lot of money trading it. I mean, don't get me wrong. It's a very, very profitable business. So, while you're losing, let us say, in terms of valuation on your net position at every quarter or every month, if that's the way you account for it, the profits from trading should pretty much cover it. But I would say that the short positions that they have now, and bear in mind that, rising prices just makes the whole thing worse. I would not be surprised if we have 1 or 2 of these players getting into trouble. I mean, we're talking about very, very large negative positions on their balances. And if you're a director of a bank, or let's say running the Treasury Department of a bank, and you're looking at the commitments that you have in these markets, you sort of think, well, if I want to de-gear my balance sheet, that's probably where I got to go. I don't think it's easy for the traders, if you like, in the swaps and in the bullion bank traders and all the rest of it. I think they've got themselves into a really difficult position. I think there's a problem with the approach there. The idea of gold's true value. Gold's true value in fiat currency is what you see in the market now. And the other thing I would say is that, if you're expecting the gold price to rise, actually what you're looking at is a fall in the value of your fiat currency. That's actually what it's all about. It's not about gold rising. I mean, you've just got to look at the value of gold over the millennia, and you can see that the purchasing power of gold actually varies remarkably little over big, spans of time. I mean, If you look at individual things, they come and go. The value can increase substantially or decrease substantially. But if you look at oil, for example, since 1950, it was priced in 1950 at $2.53 a barrel. In terms of gold, the price today is actually slightly lower in gold. In other words, the value of gold is slightly higher measured in oil from 1950. But at the same time, if you look at it in dollars, it's now $70 a barrel from $2.53, and it has been $140. And it has been very briefly negative, if you remember, when there was a delivery problem in April 2020. The volatility is not in gold, it's actually in the fiat currencies. That's what's happened. It's the purchasing power of fiat currencies which is going down, and I would say they are now falling at an accelerating rate. And that's the important thing. So when you look at the gold price and you see it rising, it's not gold rising so much. I mean, obviously there's an element of it, rising for whatever. But in the main, it is really your currency going down the Swanee.
Conclusive evidence reveals that as national debt surged from $5 trillion to $35 trillion, gold prices have skyrocketed by 10 times, gaining over 826% since 2000. If historical trends continue, gold could reach $5,000 an ounce when U.S. debt hits $70 trillion. How do you see the relationship between gold, the dollar, and rising debt impacting the future of global finance? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.